We get this question a lot at the Capital MatchPoint. Which is right for our company, debt or equity? And, there are two really distinct types of financing, and you need to understand the benefits and the implications of each before you can choose. Now, debt is an infusion of capital into your company with the expectation that there will be a periodic repayment in the form of principal plus interest. Now, the end result is the ROI for our investor, or the return on investment. A good example of debt funding would be loans or bonds. There are some pluses and minuses. The biggest one for debt that's positive is you don't have to give up equity ownership. Now, the downside is this. You must have sufficient and reliable cash flows and collateral to back it up with. So it's really not a good option for most newer companies. Now, let's take a look at equity for a moment. Equity is an infusion of capital in exchange for stock of various types representing ownership in the company. Some common examples would be common stock, a preferred stock, a combination with warrants, which are the right to buy the stock back at a future date at a given price. And the positives here are that you do have an infusion of cash and no debt service attached to it. Now, the downside is really that this is a very high price or high cost, the most expensive financing possibly that you might do. But you might ask the question, why is that? Well, it's like this. Equity investors take on a high degree of risk, and in exchange for that, their expectations are for a higher ROI. So naturally, they're going to want sufficient equity to cover that. Now, if a capital seeker or an entrepreneur is raising money and has questions trying to evaluate the benefits of going with equity or debt financing, we welcome their call here at the Capital MatchPoint. I mean, that's what we're here for, to help you get your company funded.